Welcome to the deep dive video update. This is a video that I do once a week, and I need to explain a little bit the logic behind this video because it may mean something different than what you think by seeing the title to this. Every week, I go through a number of different charts, hundreds of charts every week. I pick out those charts that are really saying something right now, and those are included in the other videos. Well, then I prepare this video where I go through the charts that really aren't speaking all that loudly right now, but sometimes we can still get some insight from looking at those charts. There's also some additional charts that are unique to this video. This is being prepared for Monday, August 26th. I do have a thing called the SPX Investing Program. It's free right now and may be free into October, where I have additional videos that I post. There are courses that I have there, and I'll be rolling out more as we go through time. If you want to learn more about the program, you can send me an email, or there are links below this video that will take you to the website or take you to a playlist of videos that you can learn more about the program itself. So please feel free to check that out and see if that's of interest to you. The daily video is the real foundation of what I do as far as analysis and commentary. Then I have a number of videos that I do each week. This is one of them, the deep dive video, but everything points to the daily video. If you really want to keep in tune with what's happening in the market and start to see things develop before they actually happen, the daily video is really the place to look for that. Okay, so the first chart that we look at is unique just to this video. It's for informational purposes. We don't use this to make decisions. This is a chart of the VIX, but the VIX is invisible. Over top of the VIX is a 50-period exponential moving average, and this gives us an idea of the general range over time. When the VIX was first created, it was created using static numbers, 12 to the downside, 20 to the upside. And we still use those to a degree, but by looking at this chart, you can see we go into different ranges for the VIX, and we want to adjust things. Typically, if the VIX is higher, that means stocks are under pressure. This was the whole great financial crisis here. Then we got down into a lower range as stocks were going up. Then here's the whole COVID plunge, and then into 2022, where the VIX spent a lot of time at higher levels. Now we're down in a lower range. We have been declining. We don't necessarily pay too much attention to the direction of this overall. We just want to see where most prices are at right now. And as the market's been going up since October of 2022, the VIX overall has been declining. So this gives us some information to work from. Another thing is, I do show this when it's really telling us something. This measures the speed of the VIX as measured by the RSI based on 9 periods. We look for extreme positive or negative readings. Right now, we're just about in the middle. And when we were really going down earlier in August, yeah, I was showing this chart a lot. But since we've settled down and the VIX has settled down itself, we've come into a lower range here with this particular chart. Then I do a number of different studies on the VIX. One study that I don't talk about all that much, so I show it in this video, is the VIX to another indicator called the VIX of the VIX. So it measures the volatility of the VIX, and then do a ratio between them. Typically, as a general rule, when this ratio is going down, stocks are going up, and we have continued to go down lately, even after the pressure that we saw in early August. Then another study on the VIX is the VIX to S&P 500 correlation. When we get above this dashed line, we can use this like the VIX, even if the VIX is not really telling us much in and of itself. We look at the relationship between stocks and volatility, and this is when the market is considered to be nervous. Well, right now we're getting a very low reading as the VIX has really been coming down, so we're not really getting any additional insight right now from this. Then we look at the volatility of stocks and do a ratio with the volatility of bonds. This really went up as we saw that big decline in early August. Since then, it's really been coming down with the volatility of both stocks and bonds. And then to keep an eye on where are we in relation to the previous all-time high, which was set in early 2022, we're up 16.93% as of Friday's close. Then stockcharts.com has this thing called technical alerts. I post them every day, but what I show here are all the different alerts for the particular week taken all together. And we start at the bottom and then we read things from the bottom up. And when we have up days or the market's really moving to the upside, we tend to see blue or green alerts here. When we have a down day, that's when we see an awful lot of red. Well, Thursday ended up being a down day. Friday was an up day. So that's why we see a lot of blue on Friday and a lot of red on Thursday. And you can just look at this and see the colors overall to determine, okay, we're seeing some technical breakdowns on down days, or we're seeing some technical strength on up days. Then another thing that stockcharts.com does is you can do this with a stock and sector and index. Well, I do it with an index. And I look at 5 main indexes, the S&P, which is the foundation of everything that I do. But we also look at the Dow, we look at the NASDAQ 100, the mid caps and the small caps. And then we rank these on a score of 0 to 100. The higher the number, the better looking that particular index. And coming in first place now is the SPY, which is the S&P 500. Not really gangbusters right now. When it's this particular index or any index is really strong, we would see a score into the 90s, but we're still coming in with a score of 81. To give you a little bit of context, you can see how we were really dropping down below 40 here in early August, and we've been coming back up, but we've been also drifting a little bit lower as we ended up last week. But this is the strongest looking index technically right now. In second place, which was in last place a week ago, are the QQQs, which is the ETF for the NASDAQ 100. In August, this had dropped down actually below 20. Well, we've been really coming back up, but trailing off a little bit as the week finished out, but it's coming in with a score of 67.5. Then in third place are the small caps, which had been really weak earlier in the year, then started to show some strength. Then they were showing some weakness again. Now they're looking a little bit better at 65.8. Then are the mid caps in next place here at 59.7. Earlier in the year, we don't really see it that much here on the chart, but this was one of the strongest indexes in January into early spring and late winter. Well, now it's kind of falling back a little bit and is falling out of favor, coming in at 59.7. And then in last place right now is the Dow. Even though it's flirting with all-time highs, not too far away, it's just not looking all that strong technically, coming in at 48.1. And we look at some short-term charts. This is a rainbow chart that uses moving averages that are different colors, so it looks kind of cool. And we go from 10 periods up to 50 periods. And I try to make this chart stay big, meaning get as much dates or as long a period of time as possible in this chart. And we can see that after really coming down in early August, we had broken below the rainbow on a short-term basis. Now we're starting to get back above it as we've seen the market really improve as of late. Then here's another short-term study. This is a simple moving average based on 20 periods of the open, high, low, close. We're well above all of these lines and we're turning back more positive. So the lines in this little mini rainbow are starting to go back up. Some intermediate term charts, another rainbow going from 50 periods up to 100 periods. We came down through the rainbow and dropped below it, but this moves a little bit slower. So we really didn't see the lines start to jumble up all that much. They did move a bit here, but then we've been coming back up and we're above the rainbow. So this suggests also and confirms on a trending basis that the intermediate term trend is positive. Then we want to keep an eye on the distance from the 200 period moving average to current prices. If you notice, when we get up to a high reading, anywhere from 14 to 15%, a lot of times that can signal that maybe we're getting a little too far away from the 200-day moving average. We had that happen in July where we were up over 15%, and then we saw the decline going into August. Now we've been recuperating a lot of that, and we're up over 10%. We'll really pay attention to this if we get back up into the 13, 14, 15% area. And just doing some measurements, when we go back to the low set in October 2023, and how far have we come since that time? we're up 27.17%. A really nice move. Then, as we were going down in the middle part of July into the early part of August, I was keeping an eye on this because if we fall 10% or more, that's the definition of a correction. And when we were really moving to the downside, we were hitting support on some intraday charts, daily charts, weekly charts, and we started to bounce up off of that. And we've been bouncing really nicely ever since then. But when we get close to that 10% level, that can act as a support level as well. And if the market was going to start to turn even weaker, we would go down more than 10%. Well, we didn't do that. And the smart money started to come in and buy and support the market going back up. We keep an eye on a thing called Bollinger Bands. And as I usually mention, there's books written on just how to implement Bollinger Bands. One indicator that I use is called the percent B indicator, and that just measures when we go above or below the upper or lower Bollinger Band. We're not there right now, so we are still positive since the Bollinger Band indicator itself is above the midpoint. But we just look at this, and because when we do go outside of one of the bands, we tend to not stay there for very long. So we're looking for some kind of an adjustment to price. But right now, it's really not telling us anything. Then we were really following this earlier on as we were going down. We actually fell below the 100-day moving average. And it's like, okay, are we going to go all the way down to the 200-day moving average? Well, we didn't do that. We hit some support areas here in early August. We've been able to bounce back up, get above the 100-period moving averages, and now we're kind of far away from that. So I stopped showing this chart in the daily videos. And some other approaches to using moving averages, where moving averages look back. So if you have a 10-period moving average, it takes all 10 of those periods, adds them up, and gives you the average price. That's a simple moving average. Well, there's another take on that called an anchored moving average. And going from a high or a low, sometimes these areas will act as support in here. We broke through that support on the way down, but we were able to get back above these anchored moving averages on the way back up. We want to keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500. And they're underperforming a little bit here. Both are going up and both are looking pretty solid. But when you do a ratio between the two in some of the other videos, it's showing that the S&P 100, it's longer term, it's in an uptrend compared to the S&P 500. But lately it's been underperforming as we're seeing the rest of the S&P 500 improve and the large caps start to slow down a little bit lately. But really all we look for on this chart are just any kinds of signs of divergences, negative divergences. We're not really seeing any right now. They're moving more in tandem with each other. So we're not getting an awful lot of insight from this chart. Then I have shown this throughout the last few weeks as we've been going back up. These are point and figure charts. And when we have an X, that means that we're going up. When we have O's, that means we're going down. And we're not really seeing anything all that spectacular right now, but we are working off of a double top breakout that was generated on August 18th here. So we're looking pretty solid and positive overall. We did see some new X's drawn in on the weekly chart, and then throughout the week, as we've been bouncing back up, there were some X's drawn here, but after Friday, everything is black. Then we have a long-term rainbow chart going from 50 periods up to 250 periods. And when we were coming down, we came into the rainbow, but we didn't stay there very long. So it really didn't change any of these lines. And since then, we've been able to come up out of the top end of the rainbow, suggesting that the long-term trend is also positive. So looking at these rainbow charts, we see the short, intermediate, and long-term trends are continuing to be positive. This is a long-term oscillator that we use called the Special K. When we're above the red line and going up, that's positive in the longer term. And we were coming down, but we started to turn back up. So this chart remains positive. Since we don't see an awful lot of crossovers here, I don't show this chart in the daily videos unless we're having a cross that actually occurs. Then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX in the middle area. Not really getting an awful lot of insight here. As we look at the correlation between the top chart and the middle chart, they're not quite neutral, but they're not really going in lockstep with each other either. So And this just means that they're either going up or down in tandem with each other, but that's not really happening right now, is the US market has been a bit stronger than the German market. Then some different support and resistance areas. I was really showing this chart as we were going down in early August. We almost got down to this 38.2% retracement level, but since then we've been bouncing back up. We have not set a new all-time high. So there's really nothing to gain from looking at this chart. If we do keep going up and set a new all-time high, these fib retracement levels will be adjusted. And some broad market measures. I look at the VIX as it applies to the S&P 500. This is the VIXN as it applies to the NASDAQ 100, showing how volatility really went up and has been coming down lately. And then we do some ratios, the S&P on top, and then a ratio between the NASDAQ 100 and the Dow here. And we see that they have a pretty strong correlated relationship with each other. And then we look at the transports because we want the transports to do well. And in good, solid environments, the red line will be above the black line. That means the transports are outperforming the Dow. The transports have been a real disappointment in 2024. They've been pretty much chopping sideways as the Dow is not too far from setting a new all-time high. But this would be nice. This would help the market be stronger if the transports could really get going, but they just have had trouble in this environment. The bank ETF, the financial sector itself is one of the stronger areas. Inside of the financial sector is the bank ETF. We want to keep an eye on this because this really started to fall apart during the great financial crisis. So we just look at different areas of the financial sector and banks, and this is still looking good. We're in an uptrend and we're going up. We're above the 50-day moving average. Another area are the regional banks like Silicon Valley Bank, Republic Bank, New York Community Bank. Still not seeing an awful lot of strength here, but we've been chopping sideways in most of 2024 enough to where we might be getting ready to see a golden cross here. This measures the regional banks, which are smaller banks, with the financial sector itself. When the financial sector has been doing really well, so to see the regional banks show some improvement means that there's some strength in that area as well, if we can keep going up and actually generate an uptrend with this ratio. Then some rate of change charts. I just use these for informational purposes. They go back 250 periods just to show what price is like now versus 250 periods ago. That's about an exact year. Usually there's about 253 trading days in each year. I know a lot of people use the 200-day moving average, and I use that too. But to get more exact, we get closer to the 250 range. This is also a 250 period rate of change. And we're going back up here. We get a little bit concerned if we go above the blue line, but we're not crossing back above that yet. It just means maybe we're getting a little extreme on a long-term basis. And we did earlier on. We got above the blue line, and then that's when we started to see a pullback. We're going back up, so that's positive. But if we get back up to this blue line, that's when we might take notice of this. Then we keep an eye on bonds. We compare it to stocks, where we look at the long-term bond ETF, that's TLT, compare it, and that's in blue, and compare it with the S&P 500 that's in red. We look at their longer term correlation, not really strong, but getting a little bit stronger. And then their short term correlation, which does tend to be a little bit stronger. And you can tell just by looking at the red and blue lines when they're going up to with each other, that improves the correlation between the two. When this really starts to decline, that means they're going in opposite directions. And we look at the Qs to the TLT. Instead of blue, it's red here, but there's really not a strong correlation between them right now. They're having a slight tendency to go in opposite directions currently. And we look at a weekly chart of the 10-year yield in the US on top, and we subtract the German 10-year yield. And then in the middle area is the US dollar index, because we're keeping an eye on the relationship between interest rates and especially the US dollar. We can see they have a pretty strong correlated relationship currently. Now, US rates are higher than German rates. That's why we get a result that is above zero. And it's been coming down as the dollar's been coming down. And so this correlation has actually been getting a little bit stronger. We're keeping an eye on the yield curve. One of the reasons the Fed kept interest rates higher for longer, and it looks like they're going to cut them in September. We just don't know by how much and if they're going to do anything after that. But the employment situation has been quite strong, and that's what the Fed used to justify keeping rates higher for longer. Well, if the employment situation starts to see some weakness, like we saw at the beginning of August, and that carried over into the decline that we saw, well, then at that point, what'll often happen is these yield curves, which are inverted, specifically the 10 to the 2 and the 10 to the 3 month, they will go back to being normal. And a lot of times that starts a countdown to see if we're going to go into a recession. Now, the market is anticipating that we won't. But if the employment situation continues to deteriorate with the employment reports, now the weekly jobless claims have been doing okay, but if the bigger picture employment situation starts to struggle, these yield curves will go back to being normal. And then, like I said, we'll count the countdown to see if we actually go into a recession. So this has been this way now for a couple of years. So we really haven't had a need to show this chart all that often. Then we look at TIPS, which are Treasury inflation protected securities. These are what folks get into when they're worried about inflation and worried about interest rates going up. And when this is going down, that means folks are getting into 3 to 7 year bonds, and inflation worries seem to be subsiding. Now, we were really coming down with this ratio in late July into August, but what was the context of that? There was a real concern that maybe the economy was running into trouble. We want this to decline. That's more positive for stocks, but we also want to know the context as to why it is actually declining. Since then, it's been bouncing back up. We're getting close to seeing a death cross here with this ratio. Eventually, to be more positive, we want to see this ratio turn and go back down. Then I have a number of things called possible positive scenarios. These are some different studies here that I use when the market's really going down. I use these heavily in 2022. This measures the percent of stocks in the S&P above their 200-day simple moving average. Now I have another chart that does the same kind of study, but I look at it in a little bit different way. When we're above 50, that means we're positive, and then we can use this chart like an oscillator to show if we're extreme positive or negative. We're not getting any of those readings, and what we need from this study, we're getting from the other chart that I use, so I haven't been showing this. Then I use that same basic idea with those stocks above their 50-day moving average. Also positive, since it's above 50, we can use this like an oscillator, not getting an extreme positive or negative reading now. So this chart hasn't been all that helpful either. We do that same thing with the mid caps above 50 and showing some improvement. So this is looking positive. And we look at the small caps also above 50 right now. So we're not really getting any kind of an extreme reading. So I just refer to this chart in this particular video. Then we have a thing called the Hindenburg almond, and we did have one triggered earlier on July 9th, but it was not confirmed. We have to see another spike come up to confirm that. The perma bears all get all hot and bothered when we just see one of these. They say, oh, we've got a Hindenburg almond, but no, a true Hindenburg almond will have a confirmation signal. We didn't receive that. We're not seeing another spike right now. So there's been really no need to show this particular chart either. Thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.